Let me start with Kathryn, because we were talking, Kathryn, earlier about just exactly what I think what you're saying is that the market for about a month and a half has thought, oh, there's going to be a pivot or there's an implied Fed put, and they were going to orchestrate a soft landing. So they're very aware of the first Hippocratic Oath rule, and that is do no harm. But that may have been misguided logic, as we saw yesterday.
I think it is misguided logic. My suspicion, Joe, is that we are in a bear market rally. I think it was wishful thinking and a Fed trying to, or the market trying to bend the Fed to its own will and expecting that this fabled Fed put is still in existence. There probably is some still support from the Fed if the market were to collapse. The Fed would probably scale back the velocity of its maturities, which, by the way, are going to double next month. The market doesn't seem to care about that, but I do. I think that going, to $60 billion in roll-offs on the Treasury front and 35 on the mortgage-backed front will make a difference, and the market doesn't seem to care. I do believe that the Fed needs to paint a stark picture, and I really like what the Bank of England did. I'm not saying we have to say we're in 5 consecutive quarters of contraction, but it's so refreshing, isn't it, to hear a central bank come out and say, this is the reality of the situation, and to get to 2% inflation, we're going to have to see the unemployment go higher and recessionary forces.
Yeah. I don't know. Is it refreshing? It's like, man, we really screwed up. I mean, after 2008, we never normalized. And then after the pandemic, we never normalized. We put the punch bowl out there like drunken sailors. And now they're telling it. That's like the arsonist taking credit for putting out the fire.
Hey, at least they'll gain back some credibility. And I think it would be a positive thing to come out and say, to get back to 2%, we got to get inflation up to the new NAIRU, which is about 4.9%, because I think that's what's got to happen. So what I'm telling investors, Joe, is to position for a real recession, a recession where you see unemployment go from record lows, 3.5%, more towards above 4%, probably 4.5% by 2023.
So, Rich, when we were, and I'm not going to talk about individual meme stocks because I understand exactly what you're saying, but when it was happening and there was all this interest and there was stimulus checks from the pandemic and everyone's playing these things and everyone said, okay, it looks like it could be behavior that long-term is not going to be great for the stock market. But a lot of other people said, hey, we're democratizing it. We're bringing everybody in. It's great, retail. And there was a lot of action. Robinhood, look at all the action. That dried up, didn't it? And was it a good thing for the industry?
Well, Joe, I think what we're seeing this time is this meme stock activity. And again, we won't talk about the individual stocks, but the overall activity now is much more concentrated in a select number of stocks than it was, in the first quarter of 2021. And then what also is the difference is there's a lot more trading of these index options, the S&P 500 index option, the Qs, and the spiders. So to me, it's telling me, we lost a lot of people, over the last year and a half in the market correction. But there are some that have made it through and are more sophisticated and are trading, index options rather than just the meme stocks themselves. So
if we were at an 8 or a 9 for retail interest back then, where are we now, Rich? Is it like a 4 or something, just in terms of trying to understand? I mean, I look at the IPO market, the big piece in the journal today. I mean, it's just like it's dead. There's just nothing, and companies are sitting around. They can't, there's no way that they can come public. They're biding their time. Is it any better in retail right now?
Yeah. So good analogy, Joe. If it was a 9 or a 10 last year in the first quarter, it's probably, my guess would be around a 6. There has been an uptick in activity over the last few weeks with the market, rebounding. But it's fragile, though, too, Joe. There's a lot of it. And I talked to a couple brokers, and they're telling me their customers, FOMO, the fear of missing out on the rally. That's what drove a lot of activity. And, there is that buy and dip mentality with the market rebound. And we certainly had a dip yesterday. So it's not like it was, a year and a half ago, but there has been a rebound.